Okay, time for another Q&A session. First one, isn't there a risk to the Fed signaling one of their goals is now helping put a lid on interest expense? Well, um, I never suggested that they make it one of their goals, only that they consider it in their other goal, which is full employment, meaning economic growth, that you are promoting robust and resilient economic growth. They can't change their mandates. Only an act of Congress can change their mandates, and Congress can, if they want. Say you have three mandates. One now is managing our interest expense. Lowering rates is only a band-aid to delay the results of fiscal profligacy. Well, do you really think your elected officials are going to do it on their own? And if you think uh, that there is a result to all of this, and if you are American, the result will not be good on you. Um, Tax rates are going to have to go up significantly. Borrowing costs are going to go up significantly. It could push the U.S. into a very deep recession, even a depression. I don't know that you want that for your country. I think you'd want to do everything you possibly can. Um, but if you're looking to your elected officials to start being the adults in the room, it's not going to happen. I wonder if the Fed is in full agreement that they should cut, but they understand the political risk of doing so. Well, I think they're all aware of the political risk of doing so. I think they don't want to look like they are political, so now they pretty much can't. I think in private discussions that's being talked about. I think publicly they probably would avoid that. Therefore, waiting it out. Start with a few dissenters at the last announcement, aiming to get more on this one so that the rate cut in September no longer looks political. That is probably um, on target, I think. If the data gives them permission over the next 6 weeks to cut, yeah, I think they're ready to do it. After these relentless public targeting of Powell, can't the Fed chair go out in the next press conference and say, "I can't do this anymore. I resign, and Donald Trump is not my president"? He's not going to do that. I mean, he can do anything he wants, but he's not going to do that. I came across 11 Labs, which has some excellent voice cloning features. Basically, you can upload the audio file of your voice in 2 or 3 episodes of Market Outlook will clone your voice. I've done that before. Yep. I have been using a combination of ChatGPT, Gemini, Video Scribe, and 11 Labs to create some training videos for new joiners at my workplace. And throughout my career, I've been in some capacity where I've had to do trainings with AI. I see it has got a lot easier, more durable, and more importantly, going forward, I don't have to take people into a room and explain the same concepts again and again. Making training videos has gotten easier. The best part is I don't even have to speak for each video. My take is that AI is going to make these kind of tasks much easier, which frees up bandwidth and allows expertise to be applied to other things. Yeah. I just don't see the point on how AI is going to create jobs in the future. Through all new general purpose technologies, end up creating new jobs after a while. Well, let's look at what I'm doing. AI has helped me increase my productivity because I no longer have to write things out. I just have to give it bullet points, which are half the time. The other half the time is actually writing out those bullet points. AI does that for me. So I can produce content at a much faster rate. So I don't need to hire, we'll call them analysts, to actually do the content for me. I don't have to hire anybody for that. However, because I'm producing faster content, I need to get it into the system. So I had to hire one full-time person to enter questions and PDFs and infographics into the system. So it did create a job, but it did not create a $150,000 job. It created a $50,000 job. See the difference? You still will create jobs, just lower value jobs. So I need data entry before I really didn't need it because I wasn't producing content fast enough that would require a full-time person, but now I can. So it does create jobs. It's just going to create lower value jobs. Now, I am sure if I hire a programmer, I can probably automate this whole task. That once I have the output in an infographic or a question or a PDF, since this is repetitive, I'm sure all of this can be programmed in. I'm sure that can be done. So even that, at some point, there will be an AI agent that or a string of them that I can then have programmed that will interact with the website, because you put the same things in the same places, following the same instructions each time. That's a repetitive task that can be coded. So in essence, I truly didn't even need this one either if I really wanted to push AI to its limits and get it to do everything I can. But immediately it has eliminated the need for me to hire here. Let's see. Thanks for creating the fact sheets with earnings highlights. Thoughts on adding simple charts showing key metric trend that a company reports on. Home builders, average home selling price. I was able to get it done ChatGPT. There is a point at which I hand things off. All right. For me, if I start taking on all of these extra things, then I have to reduce the amount of output, because if you say, well, I like the earnings infographics, those are really good. Can you add this, and this? Well, then that's not 15 minutes to 30 minutes of my time. Now that's an hour to 2 hours of my time. So if I'm doing 10, now I can only do 3. Right? And then somebody will say, can you do this, and this? Well, then that is now 2 to 3 hours of my time. I might only be able to do 1 a day. So at some point, because I don't know what anybody wants, at some point I have to hand off the rest of it to you. Say, look, I've got you this far. You want this. This other person wants something else. You want something else. You all have AI. Why would I do it when I don't know all the variations of what everybody would want, right? The more I take on, the slower the content output becomes, and the more I have to add more and more and more to appeal to everybody. So that would, sure, you can add more and more and more and more, but there comes a point after which, after every earnings report, I've been asked for so many things, I'm now writing a 30-page report. I can only do 2 of those in a month, if that's the case. And now I've just become an analyst that's not using AI anymore. So on Discord, you can do this chart that you just did, and you can then share it with the whole community. And somebody else is doing other charts, sharing with you. The option price is based on the forward price of the stock, not the spot price, correct? So if you buy an at-the-money option, your break-even price will be the forward price of the stock at the time of expiration. No, your break-even price will be the forward price at the time of expiration plus the premium you paid, not just the break-even price. You got to get to the break-even price, and then above that by the premium that you paid. When calculating the forward price of a stock, is it considered the borrowing cost of that stock? It is. Black-Scholes will do this for you. Black-Scholes has in the formula T, which is time. It has T in the formula, so it will do it for you. But it is basically the cost of carry, yes. Otherwise, could be more efficient to short a stock with a long put instead of shorting it directly. You mean buying the put? Well, the put will be cheaper if interest rates are higher. I don't know what your definition of efficient is. Do you mean efficient in the technical sense of the amount of return you get for unit of risk? I don't know that it would be any different. Your return would be different because you have a more leveraged return. But deleveraging that, which is how you would determine a ratio or any kind of ratio to risk that you take on, would be the same. The borrowing cost shouldn't be added as a cost for a short position. The borrowing cost is not added, it is discounted. So if you borrow money to buy the underlying, the future price or the forward price will be higher. If you short something, you get funds today which will earn the risk-free rate so that the price will be lower. So if we're looking at the price of calls and puts, let's say at the money, and let's say it's 30 days to expiration, and if the interest rate is 0%, and you're at the money at that point. In other words, the strike price of the put equals the strike price of the call. Let's just erase some of this stuff to get a little bit more room down there. The implied volatility would be the same on both. That means the cost of the put will equal the cost of the call. And we're assuming no dividends. No dividends at all. And for simplicity, let's make it a European call final day exercise only. The put and the call will cost the same. Now increase the interest rate. As you increase the interest rate, the price of the put will be less than the price of the call. The interest rate increases the price of calls, decreases the price of puts. So at very high interest rates and very low volatility, puts are really cheap to buy. To your last point, the borrowing cost shouldn't be added as a cost to short a put. If you can put the stock to someone, that means that you get money, right? You get the strike price. So if you put it early and you get the strike price can earn the risk-free rate up to the time of expiration. So it's not really a cost, it's more of a benefit. Argument for a rate cut, let's exclude tariffs and say the effect is 0.1. Why would Fed cut? Last CPI headline print was 2.7, core 2.9. The CPI is not what the Fed pays attention to. It pays attention to PCE, the personal consumption expenditure, not the consumer price index. So PCE always runs lower than CPI. That is their benchmark. You can't just substitute out one benchmark and put another one in and say, see, it's higher. That's not their benchmark. It's higher last summer, 2.4, 2.5. The goal is 2. Unemployment was 4.1 last read. Last summer it was 4.1, 4.2 as well. You have a flat or even lower unemployment rate, higher inflation rate. Forget politics and tariffs. Why would the Fed cut? Well, why wouldn't they? So what you're saying is you're basically laying out an argument saying last summer we had this summer we have that. It's pretty much the same, but they did cut 100 basis points and it's pretty much the same, so why not cut another 100 basis points? There is growing evidence that the economy is the economy, and what the central bank doesn't really do a damn thing. You had extremely low interest rates from 2010 to 2020 and lots of QE, lots of money printing. Where was inflation? Where the hell was inflation? It was nowhere. Japan had that problem too. It had to print and print and print and print to get inflation. Very strong currency. And they're standing around shrugging their shoulders going, but our growth isn't that great and we got a lot of debt. What's going on with the yen? So they had to purposely print yen and sell yen to push down the value. And inflation still never showed up because companies are super efficient at almost everything they do. Their value chain is optimized. Every penny is constantly being squeezed out of that system. Every penny they possibly can is being squeezed out of that system through improvements in technology, headcount rationalization. This is always going on. They're never just passive recipients of things. It's always going on. So the idea that 4.33% is needed to get rid of inflation, you could also argue that 4.33% is causing inflation. Because if I have to roll over my swaps or roll over my debt at 2 to 300 basis points higher, I'm not absorbing that. I got to pass that on. Either I got to lay some people off, I got to cut some costs, and every dollar I cut is somebody else's revenue. I've got to do that, or I've got to pass those costs on. So you could argue just as effectively that high interest rates are actually causing inflation or are contributing to inflation. So I don't know that I would compare year over year on this basis. And we can't be backwards looking, we have to be forward looking. Last year at this time, if you would have said, have you tried AI? I would have said, it doesn't work. And I would have been mostly right by saying that it's not very useful and it really doesn't work. It's only in the last couple of months, last 4 or 5 months, this stuff has just exploded and it's everywhere and it works. So I don't know that I'm on board with you here. You will not get 2% inflation at this point. The private payrolls are printing 100, 200, 300 a month. They're not. You need stall speed. Why do you think that you can't produce those jobs? We did for many years produce those jobs with 0% as the Fed funds rate, and there was no inflation. There was no inflation. I don't know why you need stall speed. The conventional thinking is if you get interest rates up to 5.5%, you'll crush the economy. And what did the economy do? Nothing. What did stock prices do? They didn't go down. All-time high, all-time high, all-time high. This is our third year, 2 years where the S&P is over 25% return. We're now looking at a third year in a row of over 25%. So they're saying, low interest rates, we're going up. High interest rates, we're going up. Unemployment is saying low interest rates, we're about 4 to 4.5%. High interest rates, we're about 4.5%. High interest rates, GDP's running 2.5 to 3%. Low interest rates, GDP's running 2.5 to 3%. Do you see the trend here? There's zero correlation. Zero correlation, it seems, between the interest rate and all these economic data points. So why punish people with high interest costs? It doesn't need to be this high. I think the fiscal dominance with issuance on the short end and the bill is an inflationary systemic force that brings up R squared. Why? Why does, I don't understand that. Why would a 3-month issuance rolled over 8 times be any different than a 2-year issuance? Why do you feel that would be more inflationary than just a 2-year issuance? I don't understand that. If I want to borrow $1 billion, if I borrow $1 billion for 10 years, or if I borrow $1 billion and I roll it over every quarter for 10 years, you're telling me that that's more inflationary than I'm still only borrowing $1 billion to spend $1 billion. I don't understand why that would be more inflationary. I don't get that at all. And you had tax cuts in 2017. No inflation. If we see an environment where interest rates begin to approach negative 1% in the coming years, do you think that this is bullish for gold and by extension commodities in general? The biggest driver for commodity prices globally is global growth. That period, that's it. That's the big one right there. Everything else is is just a technicality. A weakening US dollar will raise prices, commodity prices, because they're priced in US dollars, but that's a technical issue. That's not, I wouldn't say that's a really big investable issue. It's a nice tailwind to have, but it's the biggest thing is growth. Right now, I don't know that we have. I think for all the commodities, I don't think it's there. Like if you're thinking about iron ore, but certainly copper, because where is the big infrastructure bills going to come over the next 10 years? It's got to come in the grid. if we are moving to a digital, more and more to a digital world, which it looks like we are, we're going to be replacing at some point the gas station with the plug-in at home. We're going to be replacing the entry-level staff in a lot of places with the computer, which requires electrons. So copper, yeah, I think that's the biggest one that I would bet on. But zinc, nickel, iron ore, coal, I don't know. I understand that one of the driving factors with gold price at the moment is volatility associated with the U.S. current administration. In a scenario where Trump and his administration is politically neutered in the midterms, wouldn't this reduce market volatility and put downward pressure off on risk off assets as its goal? Till when? Right? I mean, we're seeing that we cannot rely on the U.S. administration to hold up any bargain it ever makes. The trade agreements that will happen with under this administration is not worth the paper it's going to be signed on, because Trump changes his mind and reneges on deals all the time. So the Democrats get some power in the midterms. The question from all these governments is, yeah, but for how long? Right? They're going to switch back to this, and then in 2028, maybe it's back to the Republicans, and we switch back to that, and then 2 years later, it switches over. And being that these two parties are so far apart, right? If you think about the spectrum, one wants to govern from the left, one wants to govern from the right. So policy ends up doing this: go this way, go this way, go this way, go this way. You need them to come into the center so that the variability in policy is very small and far more predictable. But what we have right now is not predictable. Biden comes in and tries to undo everything that Trump does. Trump comes in and tries to undo everything Biden does. Then maybe you get a Democrat in 28 that comes in and tries to undo everything these guys did. And that upsets the population, which then swings back to the Republicans, who come in and try to undo everything they did. And well, the problem or at least the big catalyst for gold right now, is just the sheer political divide in what is once considered the safest investment on the planet, and the best partner for trade and defense that you could have. Now it is an unreliable partner. Even when it says it's your friend, it has become an unreliable partner, because it's like, the U.S. is our friend, comma, for now, right? For now. As soon as we have an opinion that's different than the king, we're no longer their friend. And then the trade deals are the worst things that ever happened. They're a disaster. They're ripping us off. And we start all over again. So I think that's really what's driving gold. And if there is going to be a rebalancing of trade such that the U.S. does get to balanced trade, that is $1 trillion a year that does not need to be held in treasuries. That central banks around the world says, well, there's $1 trillion less in US dollars we need, because we just don't do that much trade with them anymore, or as much trade as we used to. US dollars aren't building up. We don't have to hold them in reserve. That'll switch to some other currency or gold. My thinking. If you were in your 20s again, just started to invest, would you go long the U.S. market under these market frenzy, or diversify with CAD exposure too, especially if you're playing the long game? The center of gravity on the globe for capital is still the U.S. by far, and for innovation is still the U.S. by far. So if I were in my 20s, even at these market valuations, I know that I would be investing not once, but over a period of time. So if we think about the valuations now, let's say that markets come down, they'll go back up, they come down, they go back up. Basically, you're committing money here, you commit money here. Every 3 months, you're committing money. Every 3 months, you're committing money. You end up with a much smoother net asset value over time than what the market is saying, because You're committing money. Not only that, these things are paying dividends as well. And then you get to this point, you committing money, all these dividends add, you add more, you add more. You dollar cost average in a broad market index over the next 20 years, you'll retire just fine by 55. If you're in Canada with long-term horizon, do you think CAD hedged S&P 500 ETF makes more sense? If you're going long-term, I don't even think I would hedge the currency. In the early 90s, the currency $1.15. By the late 90s, it was $1.55. Then it went to $1. Then it went to 90 cents. Then it went to $1. Then $1.20, $1.30, $1.40, $1.45. Now we're at $1.37. So if you look at where we are now and you go back, I'd say 25 years, that's exactly where we were. Exactly where we were, but the market is much, much, much higher. So if I started 25 years ago and I look at today, I go, well, the dollar's exactly where it was 25 years ago, but the market's much, much, much higher, and I didn't waste a lot of money in hedging the currency. So if you're doing it over a long period of time, this currency does have an attractor point. It's not going to get too far away on either side. Why is it called CAD hedged ETF? Shouldn't it be US hedged? I don't know. I'm taking your word for it that it's called the CAD hedged S&P 500 ETF. It could simply mean hedged into Canadian. You know, it's hedged into the Canadian. Because we know it's US based. You wouldn't US hedge it. You would either Euro hedge it, CAD hedge it, Aussie hedge it, I pick any currency and hedge it. Nothing comes to my mind because I'm at that age where my brain decides to hold words hostage. While SPY valuations are very high, I hardly have any beta exposure in my portfolio. Wondering how to better benefit from the current low IV to buy SPY calls. I don't understand the question. How to better benefit from, you just said it. If you want to benefit from current low IV to buy SPY calls, buy SPY calls. As a long-term investor, I was thinking a 1 year, 2 year long at the money call. Low IV is more present in the shorter term frames. Looking for a efficient way to use low IV to gain beta exposure for a year or more. Well, they're all priced on a forward curve. You're not going to save any money by buying long-term, right? If you think about where the stock price is, they're priced this way. So you may think, well, if I just buy short term and I keep rolling it over all the time, the sum of all the time values is greater than the time value in this premium here. True, but you have to also consider the interest rate cost from where at the money is now to where the delta is, the 0.5 delta is there. You can't just look at the premium and say the sum of all these small premiums is greater than this big premium, because these will be priced closer to where this price is, right? Because this is just the difference. You have to look at this as well. Not only that, you're going to be buying these at 4.33%. If the Fed starts lowering rates, this is what happens to this curve. That forward curve drops. So if you bought a call over here at 4.33%, and as time goes by, the market could be rising, right? And as interest rates drop, the value of this call will continue to drop. So you would be losing money on the call just with the interest rate dropping, because we are going to get a cut in May. There'll be another central banker in there who will lean on the rest of those people, and Trump hasn't even begun calling other people's names yet. You don't want that in your life, right? If it's just a matter of, we could cut or we could stay where we are, I'm indifferent. You'll lean towards a cut because you don't want that guy in your life. He will get what he wants not because he's effective, just because he's a real pain in the ass, and you just don't want that. I remember when I was teaching, I had one student who came to me, he got a B, he wanted an A. And he would come into my office and advocate for an A. And I would say, look, the grade is the grade. He would leave, he'd walk around the building, and he'd come right back to my office and advocate for an A. I say, your grade is the grade. He would leave, he'd walk around the building, come back, and he'd advocate for an A. I said, the grade is the grade. He'd do the same thing. I said, finally, here's your freaking A. Okay, just leave me alone. Here's your A. Get out. He wore you down and he wore you down and that's Trump. He'll wear you down and he'll wear you down. It's not that he presents an effective case. It's just after a point in time, you just want this guy to go away. He'll get what he wants. So, you will get lower rates. So buying a long-term call at this point, you will lose money just with the dropping and you set a higher hurdle. Whereas if you roll it over, every time you roll over, if he drops rates, the next one to buy will have a lower price and a lower price and a lower price. Not only that, if rates are dropping, that gives power to the market. What you can do is you can start selling puts to help buy these calls. That is either a risk reversal or synthetic. As much as I would like argument for a rate cut. Okay, that's just answering an argument for a rate cut. Gemini Flash 2.5 can search the internet and seems basically the same as Perplexity. Don't you think the queries that AI is taking away from search are revenue generating queries? Yeah. Have you used Google Lens or Circle to search? Nope. Google is creating new ways to search and new ways to show ads without typing the search bar. I think Apple just copied Circle to search her latest update. I don't know anything about Circle or anything like that. The AI mode, apparently, I read an article last night. I think it was from one of the tech publications, looking at AI previews versus just straight AI mode in Google, and brands were showing up in AI preview about 35 to 40% of the time. That means when you had your AI preview, you had little references here. When you click on the reference, it was to a brand site. In AI mode, it's about 90% of the time. So I think Google is sort of figuring out exactly how they're going to monetize this. We'll see. Meta last night talked about how they're using AI to drive more advertising revenue. So there is some possibility in there. Google just has to figure it out. I'm sure they'll figure it out. In the past, you deployed a synthetic on TLT until early 2026. Yep. Should TLT not go up, how would you leave your synthetic position? I'd be assigned. Just close it and take the loss. I never close things and take the loss. If I feel that, look, if this doesn't work, I'm going to have to close it and take the loss. If I'm doing options, then I won't do the options. I only do options on something that if it is assigned to me, I don't mind having it anyways. I don't mind having it. So I'm never in a position where I close it and take the loss. Now, if I come to the conclusion that, look, this is never going anywhere, and I could be doing other things, then I'll do other things. But even when I'm holding something that's underwater, if it has options, and I can play the options, and on TLT, I can do the options quite well. For a while, it really wasn't worth it, but the premium seems to be coming back a bit. I can play the options quite well. So I'll be just fine on that. I'm not too concerned about it, but I'm not in my 20s anymore. I don't just, after 4 days of something, say, oh, it's not working, take a loss. I pick and choose very, very carefully. I don't trade the headline stuff, so you'll never see me buying MicroStrategy or Tesla or any of the names that are in the news. Or the meme stocks or the hot names. I don't buy any of that. So for the things that I do, if I'm selling puts, it's because I don't mind owning it and I have patience. I do have patience. I can wait, especially if there's liquid options and even better, a dividend. I can generate a nice stream of income off of something that stays underwater for years. So I'm not, no, I wouldn't just take a loss. I just raised 40 million pre-idea in my AI startup. Joking. Yeah. I remember last time you mentioned that stablecoin will increase demand for UST bills because each coin is backed by some ratio of UST bills. No, it must be, and not some ratio, one for one. When people buy stablecoins, they get their cash from their checking or savings account. Um, well, it comes out of the banking system, sure. But banks are also buying T bills using our demand deposit. Mm, if they have excess cash overnight, they'll do wholesale lending, but not so much T bills. No, wouldn't this just be shifting from banks using our cash to buy T? No, no, no. Banks don't do that. They'll use the wholesale market if they have excess funds, or if they need extra funds, they uh, would rather lend that money out and not just get a T bill rate, but lend it out. They do hold some government securities because they have to, but no, no, they don't hold it. Besides, if I need clearance, you got to think about clearance, and maybe you're just not in that position. You can't think about what you do in your life. What you do in your life for the bank is insignificant. You have to think about a company that has a supply chain across one, two, three, four, 5 countries, and it has to send payments on a regular basis to these countries. Maybe it has contractors and employees and suppliers spread across 5 countries. So it is holding cash in a checking account in a bank called working capital. This is not in any security at all. The bank will take this and lend it overnight in the wholesale market. It's not buying T bills, it's lending it in the wholesale market. But this has to be used on a regular basis to clear payments for this through the banking system. Well, this is not sitting in any T bills. So if you took this and you turned it into stable coins, now you're in T bills, right? And the bank just lost a source of wholesale funds for lending out. But now you can make all of these payments without the banking system, and your level of working capital is just sitting in T bills. Now somebody's getting the interest on those T bills, but you weren't earning anything here anyways, and you were paying all these fees. The fees that you save, you're more than willing to give up anything on the T bill. Somebody can make money on the T bill. You're okay with that because of the fees that you're saving and the speed at which you can transfer money. You can reduce your float sometimes up to 4 or 5 days. So think of what that means for the sum of all the money out there sitting just that is being in process of getting to where it has to go. Somebody somewhere's always got that float. By the way, Mark, for all your Apple devices going off, I know there's a way to do it. Somebody showed me how to do it on one. I did it on one, and you know what happened? Didn't work on all the others. There's people tell you, yeah, you could just do this and it'll take care of all of them for you, and it doesn't. I've tried it. And then I get the same answer, works for me. You're the only one. And I say, you know how many times in my life I've heard the statement, you're the only one. I am one really unique individual. No, that doesn't work. Why is it, why is that in Canada everyone is talking? Well, that's not a sentence. Everyone's talking about Carney's 103 conflict of interest. 103 or 103, predominantly from Brookfield, but no one in the U.S. seems to care about Trump or conflict. Well, you see, that is the big difference between the two countries. Is the U.S. has mostly abandoned its responsibility when it comes to overt conflicts of interest and even overt acts of bribery and criminality. They've just simply decided to turn a blind eye to the whole thing. So it is sort of like Rome in the who was that under Caligula, where everyone knew it was immoral and corrupt, and oh well, just shrug their shoulders. What are you gonna do? And I think that's what's going on in the U.S. now. It's like everyone knows it's immoral and corrupt. This is probably the single most corrupt president that the U.S. has ever had, and the reaction is, well, what are you gonna do? What are you gonna do? Right? I know you've been advocating inflation in the long run will be lower because of AI and tech is deflationary in nature. It seems the market at the moment disagreeing with you and believe that inflation is going to be higher due to tariffs. Let's say you are right. In 5 years' time, inflation does go much lower. 5 years? That's a long time. Than what is expected today. But doesn't inflation expectations matter more here? Doesn't seem to matter what the actual inflation is in the long run. Well, inflation expectations are well anchored. They're not. They're not. If you look at break evens or inflation swaps, nothing to see there. I mean, if you're saying, well, if you ask people, what do people know? People don't know anything. They're not the ones making the big decisions in the financial system. If you ask people, do you think aliens are visiting Earth? A lot of them will say, yeah. So ask people. I mean, what do people know, right? I don't think that that's a measure of anything other than the ease at which you can convince a large group of people of almost anything if the media tells it to you, right? So who cares about people? Example, 10, 20, 30-year yields have been reaching high 5% because people believe inflation is going higher. Well, it's not people that are buying the long end of the curve. It's really institutions. It's not people that are buying it. People are buying MicroStrategy. People are buying Tesla. There we can talk about people buying Tesla. But, people are not buying Procter and Gamble. It's mostly institutions that hold that. So we can't say people think Procter and Gamble is this. No, people aren't doing it. People do a lot of, in groups, do a lot of stupid things and think a lot of stupid things. Where did I leave off here? Also, you've mentioned in your positions video sometime before TLT or long duration doesn't seem to play out well as you've hoped. Nope, it certainly is not. If rates are getting cut as much as you expect, would you not expect the curve to bull steepen? And if so, wouldn't going for short duration treasury securities be short duration? Why? Duration is the percentage change in the price for a change in the yield. If I go short duration and yields change, the price doesn't change. It has no duration. Why would I go short duration? If you think the long end of the curve is going to come down, you want to get as much duration as you possibly can, not as little. It is not a revolutionary thing, or is it? I don't know. What? Do you still hold your view about the stablecoin having not much benefit to consumers as they can pay US outright? For the consumer, I really don't see the point. I have a debit card. I can go anywhere and I can take care of it. But I also have payments to make in Costa Rica and I have payments to make in the US. 2 individuals in the US and about 4 or 5 places in, not so much the places, just getting the money to Costa Rica is a big pain in the ass. So stablecoin, I'll do it. The US dollar is well accepted in Costa Rica. I'll do it. For me, there is a clear benefit to using some means of transferring money that has zero volatility in the value of what I'm transferring, and I have a trusted third party, and I don't have to rely on the banking system. I'll do it. But for me here in Canada, if I'm going out to Costco or Home Depot, what the hell do I need stablecoin for? I mean, I don't need that stuff, right? The current currency system works really well. So it's more for settlement, and especially cross-border settlement, that this stuff has a lot of power for. Do you use IBK or Workstation or any tool like to simulate or form your option strategy before executing, like selecting the right strike price. After a certain amount of time with a certain amount of experience, 30 years doing this, I don't need to simulate anything. I know what I want. And I think everyone does the same thing when they get involved with options. Is if you look at a timeline, right, and you look at complexity, and this is a timeline of experience. Here you have no experience. Here you have 30 years of experience. This is what happens. Is as you start learning more about it, you start getting more and more complex till you realize this complexity is bullshit, and you start getting simpler and simpler, and you're back to the simple strategies that you had over here. Except you didn't. You had the wrong process in your head, so you felt you needed more complex strategies. Then when you get to these complex strategies, you say these don't really work that well, do they? And they don't. So then you start to simplify again, but now you've developed a process, and within your process, simplicity usually is the better strategy to use. I have a gut feeling that companies will use tariffs as an excuse to raise prices more than once. That is not what we're hearing in the earnings reports. If you listen to some of the companies that are taking hits, they're saying all the same thing, that we're going to take this $1 billion hit, or this 1.2, or this 800 million, because they cannot pass it on. They're saying right in their call, we see a hit to tariffs coming. If they could pass it all on, and they were going to pass it all on the call, they would say we see a near-term effect, but over the next 3 or 4 quarters, it should be fully passed along and will preserve margins. They're not going to try to hide it from the investor. That's the point of the call. Is they would say that they want their stock price to go up. They will say that, but they're saying we have this tariff hit, meaning they cannot pass it all along. So I don't know that I would agree with that. Consumers appear to remain financially strong, and companies know they can get away with charging higher price without losing much demand for the foreseeable future. I don't know about that. I wouldn't test that. If you have a company, I wouldn't test it. I would follow the GE model on price raising, and the GE model was very simple. Every business. This was under Jack Welch, and this, I think it was a brilliant pricing model. The mandate was every year you have to raise your prices 10%. You need to find a way to raise your prices 10%. And they had some really commoditized businesses. How do you raise your price 10% in the commoditized business? You have to add more than 10% in value. You have to find a way to increase the value of what you're selling. It is okay to raise your price if you're increasing your value. That's not inflationary. Companies are not naive. They're not just sitting around going, duh, you got to raise your prices. They're not stupid, and they're not naive. They're well aware of what's going on. They're way ahead of the game. Many of them probably saw this coming a long way off. They all know what the elasticity, what their price elasticity is, what their substitution elasticity is, what income elasticity. They know all this stuff, and they're very good at what they do. Most businesses, especially the large cap businesses, they're not just fumbling around in the dark saying, what are we going to do? What are we going to do? Well, woe was us. They are very, very good at this. They are killers at this. So I don't know, especially after the round of inflation that we've gone through, that they feel that it's safe to just continue raising their price. I think they're going to look not at top line to solve this problem, but below the line, which is how do we squeeze it out of cost of goods sold? How do we squeeze it out of SG&A? And I think they're going to find something there. But I don't know that this is that to continually keep pushing your price higher and higher and higher and higher just because your costs are going up is naive. A naive thing. If your costs are going up, you need to rethink your production system to squeeze those costs out, and they're very, very good at that. Have you looked at this new thing called context engineering? Is it better than prompt engineering? Um, well, I mean, context is part of the prompt, right? There are elements of the prompt that you have to put in. Your context is part of the prompt itself. So I don't know that I would say here's context engineering and here's prompt engineering. I'd say here is prompt engineering and context engineering is within prompt engineering, right? Is you're really just giving the LLM or the LRM a lot more context about who it is and what persona it should have and what the audience, who the audience is. That's not the instruction. You haven't even given the instruction yet. You're just really saying, look, you are this, and this is what you think, or this is how much experience you have. This is the role you play. Here's the audience you have. That's all part of prompt engineering. Can these LLM, LRM be useful for entrepreneurs who require mentorship? Um, well, why would a human be any more reliable? Humans have biases. If you ask me a question, I'll answer it based on my life experience. It may not uh, match your personality and your life experience. So, what does it matter? I mean, if you ask somebody else, you have to rely on their advice being good advice. What if it's not good advice? I mean, I can make the case that Jesus was full of bad advice. And some of his advice I think was really bad. Other people say, "Oh no, you got to live your life according to the rule, according to the teachings of Jesus. He had good advice." How do you know it's good advice? Right? So I don't know. Have you found that the use these? Have you found these LLM useful when you make it role plays and experienced professional? Yes. You said you don't find the policy opinions of Joseph Stiglitz or Paul Krugman very useful beyond academic discussions. But as a beginner, how is someone supposed to know who to listen to? You don't. That's experience. I can't give you experience. Nobody can give you experience. We can give you a whole bunch of different views of the world, a whole bunch of different lenses through which to see a problem, a whole bunch of different theories and ideologies to view the world, with none of them really being the answer, but being a view of the answer. And then you have to then go through your life and you use these different theories and frameworks, and you determine for yourself what works for you. And maybe you'll even develop your own. I mean, you don't. I felt when I got out of an MBA that it prepared me absolutely zero for the real world. The real world was nothing like the textbook, and if you tried to navigate the real world like the textbook, everyone could see it coming. The competition would eat you apart. You got to throw away everything you learned. So, only later do you come back to it and say, oh, okay, well, I missed the bigger picture. It wasn't an instruction manual. It was, a scale, as opposed to, a way of doing things. It was a way to measure things. If you think about it that way, okay, well, that makes sense. But everything in life is experience and reflection. And when you're in school, you think, look, I know it all. When you get out of school, you say, holy shit, I didn't learn anything. After 10 years experience, you say, you know what? My education gave me a really firm foundation on which to build my current knowledge. Only later do you start to recognize that what you learned in school wasn't the real world, but it was the foundation on which you build your real world. What time is it here? I gotta take a break soon. Supposedly, a deal EU struck with the U.S., at least for the part concerning future investment commitments, $600 billion over a number of years. Yeah, Japan already said it's not an investment; it's a loan. Isn't just a window dressing for Trump? Yes, that's exactly what it is. It's all just window dressing for Trump. Everyone's figured him out. Everyone's on the same page. Give him a victory. That's all he really wants, is just to be on TV, to say no one's ever seen a deal like this. No one ever thought it could ever get done. It's the biggest deal ever. Money is just pouring into the U.S. The 2020 election was rigged by the Democrats. Obama should be like his usual speech. That's what he wants, and everyone says, look, we can get a fairly decent term sheet and lower tariffs for now until they go away by just giving him a public victory. Like, let's really go over the top. 600 billion, 500 billion, 700 billion, it doesn't matter. Make up numbers. That's all he wants. He'll never follow through, and these things fall apart. Korea already said, what trade deal? Japan said, whoa, 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 we never said we're giving you guys sick. We said we'll lend you the money if you need it because we know you're broke. The Chinese delegation said, we have a deal. The American delegation said, well, we don't have the authority. We have to ask the king. The Chinese delegation has the authority to agree to things, but the Americans don't have any authority to agree to any. You're seeing how these things are not really deals, or they're just press conferences for someone's ego. That's all they are. They're not trade deals. I think he throws around the word deal like it's a handshake thing and it's done and here we go, and if you renege we can go to court. These are all term sheets, agreements to start a negotiation to come to an agreement in 2 years when you're gone. They'll never come to pass. They'll never come to pass. Will EU simply move these investments away from treasuries? Oh, I don't know what they're going to do there. Regarding your view on copper scenario where the tariffs are canceled, it's already happened. I'm looking at the copper price, 434. 434 on the copper price, ended at 452 yesterday. I did a live on Discord. I said, do not touch this. It's not done. And it's not. We're down 15 cents, 16 cents from there. 410, $4, probably by the middle of August. Huge inventories of copper in the U.S. right now. So, yeah, there's no real reason for copper to rally at this point. There's plenty of supply. You got to work off those inventories. Copper drops to under 440 or as low as 410. It's under 440 now. Interested in how you would determine the timing component in your trade? I don't know. I'll know it when I see it, or I'll feel comfortable about it when I see it. And I'm not in the copper market today. I'm not selling any puts today. PDFs of the companies would much appreciate you continuing sharing with us. Yeah, the link, the Google Drive link is on Discord. Just found out there's a big inheritance tax for foreign citizens that have U.S. assets. I'm not a citizen of the U.S., so I'll just pass on that. Comment why there is a fuss on ChatGPT is I think that as I use both for my learning, and since most of the students are dealing with lower cognitive skills like declarative and conceptual knowledge, they're indifferent between the two. Yeah, at lower levels, like if you're, tell me about this, help me understand this, can you calculate this? I think all the models are pretty much the same. OpenAI does a great job presenting the output compared to Gemini, and so it comes down to the presentation aspects of it rather than deep reasoning, which clearly Gemini outperforms. And yes, I've tried to save the info of how many outputs should be presented in Gemini. Info of how my output should be presented. Just not as good as OpenAI in terms of pure presentation. I understand you've been a professor at universities, taught classes to undergrad students. As you've probably seen in the very first years of university, students become very uncertain in terms of which degree, program, or major to pursue, finance or marketing or engineering or math. Okay, assuming the student is very young, 18, no idea of what he wants to do or study, and came to university, do you think there needs to be somebody who will be deciding for them what to... No, right there, stop, no, that defeats the purpose of what you're doing. The idea that once you leave high school and you head to university, um, no one will decide for you. No one takes attendance. There is no truancy officer. You don't get called to the vice principal's office if you miss a day and you don't have a note. You're all on your own. That's the point. It's time to hand off structure for your own discipline. And if you can't make that transition, things aren't going to work out well for you, but you have to. So no one's going to decide anything for you. Oh, there's guidance counselors. There's, you can go to an office. There's offices on campus. There are career counselors. You can sit and talk with someone and they can help you figure things out. But for your first year, who cares? Every program in every school and every department's exactly the same. They're all big survey courses. And then you determine what you like and what you don't like. So being a guardian of those young men, well, we don't see ourselves as guardians. Do you think it is better to have someone experienced from both academy and profession to advise them? Or even if necessary, decide for them. No deciding for them. No deciding for them. If you're 18 and you don't know what interests you, you're just not thinking hard enough. You must have some idea of what interests you. Maybe not the actual definition of the job you're going to hold, but some idea of what interests you. And then just start down that path. You can, lots of undergrads change their major. By the time they finish second year, they'll change their major. Lots of undergrads do that. That's the point. Before AA became a thing, how long would it take you to do research? Depends on what I was doing. But with AI, a third of the time. It's cut it down to 1/3 of the time. Can you share an overview of the things you look for? In what? Given all the information and websites you have to dig through, that sure feels overwhelming to me if you don't know what to look for. Well, when you start research, sometimes you don't know what you're looking for. You won't know what you're looking for until you stumble across something and you read it and you go, oh, I should know that. I should look more into this. This looks important. And you look into it. And then that may lead you to something else where you say, okay, this looks important now and I should look into that. So it's never linear. It just branches and you'll follow one branch to a point where you go, okay, I've gone far enough on this. And then you get back to, the main line of thought. But it's messy. I can tell you that. And then it comes together in the end. It gets really messy and then it comes together in the end. Then you compile your notes, you organize them in thoughts so that all the thoughts are in the same categories. You start to write and then, you'll start to notice, once you start writing it out, you'll notice you had gaps. Okay, there's a gap between here and here. I got to fill this gap. I'm making it, there's something missing here. Then you go looking for more stuff. So it is exploratory and it's iterative. And it is not a well-defined task. I'll say it that way. It's probably the best way to say it. I understand your points about tariffs being one-time inflationary hit, but I wonder if why you don't think they can cause persistent pricing pressure if tariffs lead to shortages of certain key inputs, or simply limit product breadth availability. In all of these statements that are being made, there is the assumption that all the companies are passive recipients of bad news. They are not. They are not. The other side of this equation are all these companies that are way ahead of you, that see this happening and they're way ahead of you. They've already started months ago looking at finding a new supplier on this side of the border, or saying, okay, well, there's a Canadian mold company in Windsor that doesn't have a facility here in Detroit. If they did, we could avoid the tariff. Let's have a meeting with them. Let's send somebody out. Let's have a meeting with them. Let's see what's involved in getting them to set up a facility in Detroit, right? Maybe they need a little bit of financing, and maybe we can offer that financing for them. They are way ahead of the game. The other side of this equation are not passive companies saying, oh, we have no choice, we're getting hit. No, they are active in this and way ahead of the game. So I think that you have to look, companies are reporting record profits, even in the face of all of this, record profits. So they are handling this, and I think it's important to say, look, you've got all these Stanford and Harvard and MIT and Wharton MBAs on one side of the equation, and you got generally uneducated and stupid politicians on the other. What side are you going to bet on? What side do you think is always going to win? Right? I noticed this. I noticed from the provided chart that candidates who begin studying 12 months earlier before an exam show disproportionately high failure rate. Well, I understand the sample size in this. What do we got? Let's see if we can make it bigger. When did you begin studying? Total sample fail. 3 months prior, 1 month, 2 months, 3 months, 4 months. This is the failure rate. All right, this is how many fail. 12 months prior. Okay, where's the other one? Oh, I can only get one side of it, I guess. Okay, so this is the fail side here. You got this spike. This is the pass side here. You have this spike. So this looks big because what is this saying? 25, 30. What is this saying? 100, 200. Looks like the same distribution to me. Looks like the same distribution to me. So what this is saying is that people who pass and people who fail are distributed across that time. That there are people who start studying 12 months ahead of time that no matter what they do, they're going to fail. And there are people who start studying 12 months ahead of time that no matter what they're going to do, they're going to pass. That if these people who started studying 12 months ago started studying 3 months ago, they probably would have failed. 6 months ago, they probably would have failed. Right? So I don't see any real difference in this distribution. If you scale it if you normalize it and give it the right scale, I don't know that I see any real difference in that distribution. So that doesn't tell me anything. I had my eyes on Lulu for a couple of weeks now, built a financial model for them in Excel and calculated an annualized return of more than 15% over the next 10 years. Let's be clear what that means. That's just your best guess based on all the assumptions that you made, right? What piqued your interest in the company? I like their clothes. And I don't think that I'm a particularly picky person, but when you wear a shirt and you go, this is nice. What am I more likely to do when I want another shirt? I'm going to go back there and see if there's anything new first before I buy anything else. And if I'm doing that, I know everyone's doing that. Everyone who shops there has probably experienced the same thing I have, is that the stuff just fits better. Did you look at financial statements or something else that caught your eye? No, I didn't look at financial statements. I mean, I don't do these deep dives. Either there's a story there or there isn't. If there's no story there, then you're really buying a financial story. For consumer discretionary, that's not always the best thing to have. If I'm buying a REIT or I'm buying a utility, I'm buying almost a pure financial story with a little growth story on top, but primarily a financial story. If you're buying tech or you're buying consumer discretionary, you got to be buying more than a financial story. I know that doesn't answer your question, but question about currency pair Euro US, I know nothing about it. How would you trade this to sell it? I know nothing about it. I don't know that I would do anything about it. I've attached inflation rate, interest rate, GDP, PPP for US and Euro. Would this be somewhat accurate to sell the pair based? I don't know. I sell it, buy it. Currencies are random walks. Flip a coin. It would be just as accurate to flip a coin. Heads you buy, tails you sell. And I think that you could spend 2 weeks analyzing a whole bunch of data, and you could do that for 50 currencies and go up against a coin toss, and I don't think you'd beat a coin toss when it comes to currencies. I think the coin toss would beat you. I don't know. Past 2 decades, we've had near zero rates, exploding debt, Fed balance sheet expanded without real constraint, yet GDP and productivity barely moved. Inflation wasn't a serious issue until 2021, so most of that fuel didn't go into consumption. It seems to have flowed upward instead, with asset prices soaring. I wouldn't say soaring, but okay. If that's the case, is it fair to ask what pulling this lever again would really do for the real economy? Well, you had some of the best stock market returns in the last 15 years with interest rates at 5% and 4.5%. You had some of the best stock market returns in 15 years with inflation at 4, 5, and 6% than at 2%. So if you say, let's try to avoid this asset inflation. I mean, we're at 23 times forward earnings. It looks like we're in a bubble. We have an AI bubble forming, all at high levels of interest rates. There were no bubbles that formed at low levels of interest rates. What bubble did you see? I mean, the oil bubble burst. In 2014, $100 dropped all the way into the 40s and 50s. That went away. It's easy to say, look, these things were beside each other at this point in time. But that doesn't mean they're correlated. If I see two people sitting together on a bus seat, I don't assume they're married. They're just sitting together on a bus seat. I don't even think that their lives have anything to do with each other. So these were just things that were sitting on the same bus seat at the time. I don't know that it's correlated. I don't know that if you drop interest rates, you'd send housing prices straight up. I think housing prices would have a hard time going up. Because builders would then be able to build spec houses really cheap because the interest rate would be lower. You'd have more inventory coming online. So I'm not sure that I agree with that. Love the infographics. Yes, please continue with one company each week. Since you're implying that Google may not be fully priced at 19 times forward, do you still believe depreciation expense will outweigh AI-related revenue growth? The thing is, if we're thinking about the revenue that it can generate, no, I don't think so. I don't think the revenue will overcome that depreciation. So for pure plays like Anthropic and OpenAI, I don't see any profitability in those companies for, let's say, decades. But Google is best positioned to try to incorporate some kind of ad revenue into this. I don't know how, without ruining it. I don't know how, but that is the point. You have to keep the eyeballs, and if they don't do this, if they don't spend this money, they'll lose the eyeballs. They'll lose search anyways. So they have no choice but to do this. And when we say 19 times forward earnings, that's because they have earnings. They do have earnings. But right now it is, 54 billion of their 96 billion for the last quarter came from search ads, came from search, advertising revenue on search. That's a big deal. Even losing 10% of that or 20% of that, that's a big deal. So that, the market is concerned that they don't quite have the solution for it because, well, they haven't presented a solution for it yet. Interested in your thoughts on accelerated return notes, the structured note product sold by banks. Any structured product means that you can do it yourself. These notes offer upside leverage if the underlying index is, I know how they work. You can replicate any structured product yourself. You just have to look at what's in it. But you can replicate it yourself. What do I think of it? I think you can replicate it yourself. That's what I think of it. I think we need to look at AI and its consequences on inflation, deflation, productivity, something that will become clear over the next 12 months. Why? Why over the next 12 months? I mean, I'm using it now. I'm seeing it now. Most of what we think will happen is speculation. No, it's not. If that was not the case, we would have someone model this with some very robust assumptions. And you do. All over the place. And I'm not sure if there's any organization in the world that could compete with the Fed in terms of resources. What do you need PhDs for? PhDs is actually an impediment if you're trying to run a business. They're far too theoretical. Most businesses, when they recruit on campuses, specifically will not hire PhDs. Will hire MBAs, but will specifically not hire PhDs. MBAs are more practical, trained to be practical. PhDs are trained to be theoretical, philosophical. They would actually be a hindrance to your business, not a help. So I'll pass on that. Compute power. You don't think there's a single company that compete with the Fed in terms of compute power? They don't have a server farm. They have a bunch of desktops that aren't even connected to very much. They have no computing capacity. Research domain experts. I don't think so. I think you might have the wrong idea of what PhDs do. I think you got the wrong idea of what they do. Understand the Fed is an elephant. They overshoot and undershoot all the time. This is not a bug, but a feature. I get that that's a fancy line to say. It's not a bug, it's a feature. What do you mean? What do you mean it's a feature? Hey, let's overshoot. It's a feature. No, it's a bug. You know, just because the line exists that sounds fancy to say, it's not a bug, it's a feature. I don't see why overshooting all the time is a feature. You know, let's keep interest rates too low for too long so we create a bubble. Hey, let's keep interest rates too high for too long so it crushes the economy. How's that a feature? Sounds like a bug. Any comment on copper prices? Well, there's your comment right below. Boom, and still going down. Copper plunges on tariff exemption. Yep. Fartcoin, $1 billion. Yep. It is an index of stupidity. If you want to know if stupidity is up or down, all you got to do is look at these crypto indexes. It's up, stupidity is up. So when you're buying this, you cannot say I'm bullish on crypto. You have to say I'm bullish on stupidity. And shorting it is shorting stupidity. There's a lot of stupidity out there. And this is the stupid index, the stupidity index. All right, look at that. I got through the whole thing. Okay.